Hello, everyone. Welcome to today's Strategic Source webinar. Good to have you joining us today. This is David, the session producer, and the topic, as you see on the screen, is Strategies to Fund and Manage Work Comp Risk within Automotive Retail. Doug Austin, CEO here at Strategic Source, will be coming on in just a moment for a few opening comments and then introduce our guest presenter today. Audio is via your computer speakers. You can ask questions via the Q&A box in the lower right-hand corner of your screen. We'll try to field as many of those as we can during this 60-minute session. So let's get underway with Doug Austin, CEO of Strategic Source. Doug, you can activate your camera.
Well, welcome everybody. This is the first of a series of webinars that we plan to deliver to our client base and to other interested parties. We're going to focus on innovative suppliers that have new and unusual, innovative strategies to help our clients reduce costs, improve profitability, and in some cases even improve revenue. So we're pleased to kick this off today. This is webinar number 1. We plan to run 2 webinars every month on different topics, and our marketing and sales team will send information out to you, but we'd encourage you to look at those topics and join in every time. We will do live webinars 2 times a month, but we will post the webinar recording on our website, so you'll always have access to it. So I'm just going to move the slide forward. This is the Supplier Webinar Innovation Series, and we're really going to be focused on one of 3 things in these webinars, either expense categories, audit and recovery categories, or new revenue categories. And having said that, I'm going to turn it over now to Russ Carpel. Russ is the CEO of Comp Fiduciary, also of Level Funded Health. Our topic today is really going to be on workman's comp. We think is a prime opportunity for all of our clients to take a look at the work comp spend and see if there might be some opportunities there to reduce costs and, again, drive those cost savings to the profit line. So with that, I thank you for your attendance. I hope that you'll pay attention. We've got a couple of polls in here. We've got some opportunities to ask questions, and I would encourage you to do so. So with that, I'd like to turn it over to Russ Carpel. Russ is the CEO of Comp Fiduciary. Take it away, Russ.
Thanks so much, Doug, and thank you all for joining today, and promise to not drag on here too long, but make it as informative as possible at the same time. So we're going to move right along here to the next slide, and thank you all again for hopping on today. So today, what we will learn, just a very quick 101 on who Comp Fiduciary is. Definitely don't want this to be about our company, but more about the state of work comp, specific to automotive retail, but also applies to other industries in the middle market as well. We're going to talk a little bit about what is work comp insurance, what does a work comp policy actually do, what does it cover, how are the premiums calculated, and what are mid-market companies, and more specifically auto dealer groups, doing these days to reduce work comp premiums and related annual expenses. So moving on from there to the next slide, we're actually going to do a poll question, and you're welcome to answer that. I'll give you 30 seconds or so here to fill out the first question.
I'll go ahead and read that for you, Russ, for the group. What amount of annual workers' compensation insurance premiums does your dealership incur?
Okay, I think we can keep moving now. Thank you, everybody, for participating in that. So, Comp Fiduciary 101. So just real quickly about our platform and our company. Comp Fiduciary is a national P&C agency, very innovative, taps proprietary tech and processes and carrier relationships to, in essence, commoditize the commercial work comp space. And for companies that have moderate to good loss histories, Comp Fiduciary is able to save these corporations anywhere from 30% or more overnight in annual work comp spend. So moving on from there, this is hard to read, but that's okay. The text is a little bit small. Really briefly about myself, spent 10 years in the media space, and the last 10, 11 years has actually been in insurance, what we're talking about today. The first InsurTech platform I started was a company called forevercar.com about 10 years ago that did some very innovative, various different innovative approaches to the vehicle service contract space. Did that, and from that business had actually moved on into the commercial, more on the B2B side, commercial health insurance, specifically for, I would say, auto dealer groups that have anywhere from a few rooftops on up. And we've been blessed to have a great team and many successes and great clients in the automotive retail world on the Level Funded Health, which is the sister company side of the business here, and have saved our clients in excess of over $50 million over the last 7 years since the business started. And over the last couple of years have started the sister platform, Confiduciary, which has a similar model and approach to saving dealers significant sums of money overnight using innovative technology, marketing, and product to the middle market, specifically to auto retail. So that's a little bit about myself. Very, very passionate about insurance and I would say innovative programs and platforms and technologies within insurance, and bringing things to the table that particularly CFOs have never seen before, which is no fault of their own, but have been held back from incumbents in this space. That's really my MO and what drives me to bring these different solutions to the table. So moving on from there. So a little bit about work comp. We don't need to go through too much. I'm sure most of the people on the phone understand this is really elementary stuff, but we'll hit on a couple points nonetheless. But as a business owner, it is your responsibility to protect your workers from injuries and health risks while performing duties on the job. However, you can't completely mitigate this risk. Accidents, of course, do happen, and that's why work comp is so important, work comp insurance, that is. When work comp was initially established in the country more than a century ago, the purpose was for it to serve as a cooperative arrangement between employers and employees. Work comp provides protection for business owners and their employees, thereby reducing conflicts that can arise between two parties when accidents do happen. It's historically been referred to as the grand bargain from an employer and employee standpoint. So it's typically designed to provide comprehensive coverage to employees who get injured while doing company work, whether that's on or off site. It covers medical expenses and loss of income for employees who are injured on the job, and it can, of course, also pay death benefit to the families of employees who are killed at the workplace. And it serves two purposes. It helps ensure that injured workers get medical care and comp for income lost while they're recovering, and helps protect employers from lawsuits claimed by an injured worker. It's often called a no-fault law because it kicks in no matter who is at fault for the injury or illness as long as it's sustained on the job. It shouldn't be confused with disability or unemployment benefits, as it only pays workers who are injured on the job while doing their job, and disability pays regardless of when or where the injury or disability occurs. It's an important distinction in worker comp. Work comp also doesn't cover unemployment. It's always tax-free, unlike disability insurance or unemployment benefits. So what does this type of coverage actually do? It provides medical, rehab, disability benefits for employees who become injured as a direct result of their job, and it may also pay a death benefit to an employee's dependents if the worker is killed in a work-related incident. In addition to helping employees and their families, work comp can also help cover business owners. Work comp protects businesses from liability for employees' workplace injuries, and it keeps employers from having to pay directly out of pocket for those injuries. And this coverage, of course, may reduce the risk of significant financial loss if an employee is harmed while performing work duties. So again, pretty elementary. This is a little more of the same, so probably can breeze through this one and skip by this slide. So I will touch on this, how are premiums calculated and who needs it. Work comp premiums are basically calculated by three factors. So an employee job class, employee wages, basically the higher your employee salaries, the more you'll pay for the insurance. The employer experience rating, which is the assessment of the risk level of working at your company. It's calculated based on the number and amount of past work comp claims made by employees as compared to the industry state average. The higher the risk, the higher the premium. Who needs work comp? Nearly all states require businesses with employees to carry work comp by law, but requirements and regs vary by state. If you're an employer, you'll probably be required by law to cover all of your employees. However, you may not be required to have coverage for yourself. So, of course, regardless of the laws of your state, paying out of pocket for work-related injuries can be financially devastating for any company. Getting appropriate coverage for your business and employees may cost you in the short run, of course, cash out of pocket, but it will help avoid potentially significant financial loss in the future. Getting work comp may be one of the best financial decisions you ever make. So how do we get work comp? Every state has its own rules where you can buy work comp coverage, and in some states there is a state monopoly insurer or state fund from which all business owners must buy their work comp. There's only a handful of states that do this. They're called monopolistic states, and you have North Dakota, Ohio, Washington, Wyoming. Insureds with ongoing operations in one of these states purchase work comp protection from the state, but must find an alternate means to secure employers' liability coverage. A monopolistic state is one in which workers' comp coverage can only be purchased through the state. And those monopolistic states, unfortunately, do not allow private insurers. So really quickly about the state of the work comp industry, this was as of a month ago, which is pretty static to today in June, but premium declines overall were 10% over the prior fiscal year. That's being tracked in the industry with a combined loss ratio of 87% and $14 billion in reserve. Based on the industry standard, the NCCI State of the Line report on work comp insurance, again, the combined loss ratio was 87. Reserves are very strong, growing to $14 billion as of end of year 2020. COVID-19 claims, as people might find interesting, workers hurt by COVID-19 made more than 45,000 claims in 2020, with more than 95% of those claims costing less than $10,000, interestingly enough. And carriers reported $260 million in total COVID-19 claims during 2020. The hardest hit workers, probably no surprise, were those working in nursing homes, hospitals, clinics, and other healthcare settings, along with first responders, which altogether account for 75% of claims, so it's obviously a huge number. And of the severity of those claims, the costliest 1% accounted for 60% of COVID-19 losses from a dollars perspective. Excluding the 19 claims, claim frequencies decreased 7% in 2020, continuing the long-term lost time claim frequency decline. Claim severity. While indemnity claim severity is expected to increase 3% in 2020, the average cost of the medical portion of a lost time claim is expected to change between plus or minus 2%. So that was just a little bit about the state of the market from NCCI. So these are strategies. I want to spend a few minutes here on this slide, probably the most important, on what dealers are doing today to employ or doing today to manage work comp related risk and get costs in line. So this is a big expense. Like I mentioned up front, we have a sister company, Level Funded Health, that is in the health insurance space, and those premiums are significantly higher. I would say they're usually your second or third biggest overall expense for a corporation. And the dealers we deal with tend to have premiums anywhere from, let's say, $1 million a year to $10 million a year. But work comp is certainly no joke, for lack of better terms. From a financial perspective, the expense to a dealer that we typically deal with will have anywhere from $100,000 in annual premium up to upwards a couple million in premium, and rooftops, let's say a few rooftops on up. The majority of dealers in this, what I would call the middle market, they're not the big publics and they're not the one-off rooftop. They're mainly buying what's called a guaranteed cost. In the health insurance world, we call it fully insured. Very similar type of structure where you're paying one set amount throughout every single month and one fixed amount for the year, and it doesn't really deviate. That's similar to fully insured in the health insurance world. basically synonymous with guaranteed cost in the work comp. So if it's $100,000 or let's say $120,000 for simple math purposes, you're going to take the $120,000. That's all you're going to pay throughout the year, and you're going to break it up by 12, and it's $10,000 a month, and that price will never ever deviate. So that's typically a guaranteed cost structure. So these are your big brand name carriers. There's typically no refund, or it's a very minimal dividend type of structure where you'll get something small back at the end of the year. But think AIG, Travelers, Liberty, even the direct writers like Century and Federated, who are in this guaranteed cost structure. Probably about 60% of the market are in these structures. Not necessarily anything wrong with these structures. However, majority of dealers tend to not utilize work comp as highly as other SIC codes or other verticals. And a portion of the premium they're paying is being held back to pay claims. And it's kind of a use it or lose it scenario. So these guaranteed cost structures for many dealers tend not to be the most cost effective, which we'll tackle here in a minute. But the fact is that 60+% of the market in the automotive market still remains in these guaranteed cost structures. There are other structures out there that are a little more innovative that have been on the market for a while, slightly more innovative. And one is an incurred loss retro, which is basically a loss-sensitive program where premiums are adjusted over time, bases on losses post-audit, and money can come back to the group. There's a large deductible program where the policy receives a credit or reduction in premium based on the size of the deductible. Think partially self-funded on this type of structure. There's excess insurance, or a traditional self-funded program, which can be pretty complex and somewhat risky for mid-market, small and mid-market companies, and much more suited in the work comp space for much larger organizations with a few thousand employees or more. And there's also certainly captives, which we all know are frequently used by the state-level dealer associations. And this is essentially pooling risk, very similar to a guaranteed cost structure, where you're not necessarily being financially rewarded or necessarily penalized to a certain extent one way or another, but you're being pooled with other companies, and there are pros and cons to that. Comp Fiduciary has a private labeled, a very innovative approach with a major A-plus rated reinsurer, Fortune 500 company that has a way to kind of take the best of both worlds of the traditional guaranteed cost structure with some of the more self-funded approaches, and has come up with a program that it basically requires no transfer of risk. And for groups and companies that have, let's say, $175,000, $200,000 or more in annual work comp premium, costs can be reduced by about 30 to 50%, depending on utilization, which I'll kind of get into in a minute. But really on this slide, I wanted to just make light of the fact that there are a number of different programs available to mid-market companies, specifically to auto dealers. I think the industry is set up in a way, unfortunately, where the majority of the market does not realize that there are so many different structures available to them, let alone X number of carriers, but that there are so many different what I would call funding mechanisms: captives, self-funding, retros, dividend programs. The list goes on and on and on. And this is a category, I would say, of insurance, particularly within the auto dealer space. Again, I know I mentioned it previously, is a very big line item, not as big as health insurance, but probably a top 10 expense, well into the hundreds of thousands for some groups, up into the seven figures for others. And it's one of these things you just turn over and pay every year, but you tend not to get a lot of utilization out of it. With health insurance, with our other business, much different. The premiums are obviously bigger, but you're utilizing care. Your employees are utilizing the insurance almost every single day. In work comp, it's not uncommon to see an auto dealer group maybe only file 1 or 2, 3, 4, or 5 claims a year, if that. Yet they're still paying $100,000, $500,000, $1 million a year, and not really getting much use out of the paper. So I think it's very important to be educated that there are all these different programs out there, and to have a full dashboard view every single year, looking at all the different options and which direction may potentially save the company a significant sum of money. So moving on from there, David, I don't know, before we do the poll, if you wanted to pull up that bar chart really quickly on the product. So just really quickly, I did not want this to be necessarily a commercial about Comp Fiduciary, but about the state of the market in general. But I did just want to hit for 30 seconds on the uniqueness of this program, because not only am I passionate about it, but I do firmly believe this is one of the best programs in the country for the middle market, specifically for auto dealers, in terms of the savings that can be generated from this. So if you look at the bar chart here, the column on the far left, the bar on the far left is your traditional fixed guaranteed cost program on an annualized basis. In this example, it's $230,000. So you're going to pay the $230,000 to Travelers, AIG, whomever it may be, Liberty Mutual, Federated, Century, with really no chance of a refund. If there is a refund, it could be extremely minimal. Looking at that bar really quickly, the industry is not really going to educate the CFO on this, or the controller or the owner of the business. But traditionally, out of that $230,000, you have three components. You have your reinsurance or your stop loss. You have a portion of, we call it fixed costs, which is going to be your basically fixed admin costs. So your broker fees, your TPA fees to adjudicate claims. And then you're going to have a large portion of that $230,000. So think of it as three different buckets that the carrier is calculating in the back room before they give you that fixed price of $230,000. They're also 30 to 50% of that $230,000 is being held back for claims. Okay. Now the guaranteed cost structure, that carrier is going to want to make a profit margin on every single component of that $230,000 if they possibly can, or at least make money, a profit that is, on one of the three components. So imagine, just for simple mathematical purposes, that 50% of that fixed cost is being held back by the carrier in a claims bucket. And if you ever do file a claim, they're going to draw off of that $115,000. If you don't ever file a claim, or let's say you only file one claim a year and it's $10,000, they're still sitting there in that bucket with $105,000 or whatever the number is that you're never really going to see back. And if you do see anything back, it could be very, very minimal. So again, 60 to 70% of that middle market is still in this guaranteed cost structure. Again, not a bad structure, but if you tend to not have a lot of claims, the carrier is winning much more than you are in year over year over year, because I tell everyone, as we all know, insurance is just legalized gambling. So if we move you into the second column here, or bar, essentially what that is, can you guys hear me okay? David, I don't know if I lost signal here.
Yes, you're coming through loud and clear.
Okay. I thought I lost your earpiece signal here. I apologize, everyone. So in the second bar column, if you will, in the middle, the way the comp fiduciary is different, and this is important, is that we're only looking to make a margin on the admin costs, the broker fees, the reinsurance costs, and the claims portion that the traditional carriers are holding back. We're actually going to have we have the client, or the new client, hold back and keep that particular float of cash, in this example, $150,000. If and when there's a claim, and only if and when is there a claim, will we ask you to draw off that $150,000 bucket. So let's say you only have two claims throughout the year. You pay your $100,000, you can't get that money back, but you pay two claims and each one's $25,000. Well, now you're in total for $150,000 out of $250,000. Well, where does the extra $100,000 in surplus sitting there go? The good news is it stays in your side. You keep that float, and you can essentially reinvest that money into the next gross amount in aggregate for next year's program. So the typical company that gets on these are mid-market companies that are coming off of guaranteed cost. There's really no self-funded or transfer risk mechanism with this type of structure, and you're usually saving 30 to 50 points because, again, in this SIC code, most companies aren't filing claims, and they're being handsomely financially rewarded, I like to say, by being in this type of structure. So as you can see in the third column to the right, third bar, the potential difference is essentially $150,000. And usually the max cost is right in line, give or take 5 or 10 points based on where you are today. So this company was $230,000. Their new max cost is $250,000, but in the best case scenario, they're saving $130,000, which most companies are saving that 30 to 50 points, especially when they tend not to consume or have a high incidence of claims. So that's that on that. So, David, I think we can peel away from that for right now. Thank you very much. And I think we're going to go into a poll. We'll just give everybody a minute or two to fill that out.
I'll go ahead and read it. Are you open to a free quote on your workers' compensation program if you could potentially save 30 to 50% on your annual premiums.
Okay, so one more second here. I'm going to move on. Appreciate everybody filling that one out. So this is essentially just a slide to contact myself or us if had any questions, concerns, ideas, thoughts about today's webinar or just work comp in general. We're happy to help any way that we can. And again, really appreciate everyone hopping on today. I think we're going to do a quick Q&A here. So I don't know, David or Doug, if you want to take over from here.
Yes. Thank you, Russ. And everyone can ask questions via the box in the lower right-hand corner. Just type something in the small frame on the bottom, and that'll be coming into us, and we could forward it to Russ. And if there's a question also for Doug, I'm glad to take it there. Doug, if you wanted to reactivate your webcam to join us for this last portion.
Got it.
Okay.
Go ahead with the questions.
Yeah, all right. Again, feel free to type in questions. Here is one. Can I move to a new carrier at any time, or should I wait until renewal?
Great question. What we typically recommend is that companies do not break off cycle. With our health insurance sister company, Level Funded Health, much different companies coming off of fully insured structure can move at any time with a 30-day notice to the carrier. There are certainly ways around this in work comp, but given the financial liability and the complexity, it's typically advised against. So we would say it's safest to always wait until renewal. Given different claims and the way that the accounting works in this space, it's always best and safest to wait until the renewal period.
Again, you can ask questions via the Q&A box. In this case, it's in the left side of the screen as we just changed formats. So it's right there for you to ask. And here is another. Russ, do I need to change my broker of record for a free work comp quote from Comp Fiduciary?
No, that's a great question. And at the beginning, I mentioned how I worked in the advertising and media business for about 10 years, for what it's worth, prior to getting into insurance. And in the advertising industry, we were always accustomed to doing spec work and kind of dating before we get married, so to speak. So we're a big believer of that at Comp Fiduciary as well. We're more than happy to get to know the company and vice versa, mutual discovery session, and also giving a free quote on what we can deliver prior to any type of broker record, which I think is most companies appreciate and is pretty unique in the space compared to us against our competitive set.
All right, and here's another. Is this a self-funded program that you focus on, and or is there any transfer of risk?
No, that's a great question. And the beautiful thing about this structure is that it's not a self-funded program. There's no transfer of risk. It's not a captive. There's no pooling with other companies. You're basically being priced specifically to your group and how your group performs every single year, which is, like I said before, it can essentially lead to being handsomely financially rewarded for a good loss history and for a low frequency or incidence of claims. Technically, it's actually a guaranteed cost structure. It's just the most unique and innovative guaranteed cost structure on the market. So there's no transfer risk, backed by A-plus reinsurer, and it's also a Fortune 500 company. So it's very, very sound. And I think we are getting another question in here as I'm speaking, wrapping up on that one. It says, Keith asked, what is the typical savings percent on your client's experience? So across our book, I would say it's about 35% first year savings, and those savings are sustained for an average of about 6 years. So it's a pretty significant savings year over year over year.
Again, if you have questions, you can type something in the Q&A box on the left side as we get ready to conclude the webinar today. All right, none have come in. So, Doug, why don't I turn it over to you here to wrap up the time with Russ?
Great. Well, thank you, everybody, for attending today. Thank you, Russ, for a good presentation, a good primer on how we can reduce costs and work comp. Strategic Source is all about helping our clients reduce costs in a number of categories. There's about 130 to expense categories, another 20 audit, and another 10 revenue categories, and we can impact. We bring in innovative suppliers like Russ to kind of set the table with some new ideas, and of course we vet these suppliers before we work with them. We've got proven results, so we know it's not just a sales pitch. We know there's actual compelling results behind it. So, Russ, I thank you for your presentation today. 35% cost savings in any expense category is compelling. So, for all the folks that are attending, I would just encourage you, contact your client service manager if you want more information. We'll provide this information to Russ, of course, but in addition, you can get a hold of Keith Deans, Chris Mandry, Monica Potter, and they can put you in touch with Russ. Or if you're not a client of ours today and you're interested in learning more, feel free to reach out to any one of those three, and we can talk to you more about our ability to help you reduce costs and improve profitability. I want to thank Dave Benning for producing this today. Again, Russ Carpel. And thank you to our clients. Thank you for your business, and we hope this was helpful. And just remember, we'll be running 2 of these a month starting in July on different topics, and we'd certainly encourage you to come back and participate in those as well. Thanks very much.
Thanks, Doug, and thanks, Russ, and thank you, everyone, for attending today. A replay of today's session will be available by request. We appreciate everyone's time, and we look forward to you joining us on future webinars with Strategic Source. Have a great rest of the day, everyone.